When we manage a winning trade, unless we look to reduce exposure to one underlying, we're often rolling the position to a new one, right? So every time we, especially in like a core position, right? If you have something you always have on, when you manage that, you don't usually just take it off. You usually put another one on, which is essentially rolling, right? So for 45-day trades, we typically move the expiration out to 45 days to get a trade with similar initial probabilities, whether you're recentering deltas or whether you're extending duration, want to get the same type of trade. For 0 days, that would mean just waiting for the next day, right? So if you're doing a 0-day trade and you roll it, like logically, you're thinking, okay, I'm going to roll it to the 1 day. But realistically, you don't do that in a 0 day, because if you're doing the 0 day, then you're doing 0 day. So how do you roll in a 0 day? We just recenter your strikes, which is kind of intuitive. Now that our 0DT data set's bigger, let's examine the effects of rolling these winners. So in other words, you put a strangle on in the morning, you hit your profit target, but it's only 10 o'clock in the morning. Let's recenter the strikes and see what happens.
And a lot of times when these work, they do work quite quickly. Like when you're putting them on, before 9 a.m., you do within an hour get to take, when they work, a buck or two or three out of them pretty quickly, depending on what the volatility is. Volatility's been relatively low. It's upticking today, so you got paid a lot more today. And you'll see by putting these on the day of, you don't get that much movement. I mean, we've been down 30 handles. We've been down around 25. We've had a really tight $5 range so far today, even though the market is down half a percentage point today. You're putting these on intraday in the beginning of the day, not holding them overnight.
The reason this study is so applicable and why I like the way that this was done is when you do strangles, out of the money 0DT strangles, when they work, which obviously the only time you roll them is when they work initially, they work very quickly. This is very practical for people who are going to be trading these. It is very rare that you have to hold to like noon or 1 to get 25% out of these things. Like this happens in the first couple hours. It may happen in the first hour. We're going to use the last year of this SPX 0DT options. We're going to collect them every 10 minutes. That's just the refresh rate. We're going to sell the $20 away strangle. So in this case, if you're looking, this is very, very clear. If you're looking right now, so if you pop into the 0 days, so the $20 out of the money strangle would be, in this case, if it's 53.30, let's just say it's 53.40. Okay, it would be the 53.20 put and the 53.60 call.
You're just going to do the strangle here? Or are you doing the iron condor?
So 53.20.
Yep.
No. I'm just showing people what the study is talking about when it says $20 out of the money strangle. So it's this. It's not $20 wide as in 53.50 and 53.30. It's $20 away from each side.
From the at the money, you're saying 53.40 is the at the money.
Correct. 53.40 is at the money, so you're going to do $20 away on the put side and $20 away on the call side. So that's what essentially, if you open up the platform in the morning, this is what the study has been testing. We're going to examine the results from managing the positions, either closing them or by rolling to recentered strikes. When we close them or roll them will be determined by the profit targets, either 15% of the credit received, 25%, 35%, or 50%. So let's say we sell them for, let's say $10 and we get to $1.50 in profit. We're either in this study, we're gonna close them and also roll them. So we're gonna compare those two, just close them, taking the profit, or rolling them for the rest of the day every time we get a new 15%, and then summing that P&L and seeing what the difference is between that and just closing them in the first hour or 2 hours if they work.
And they're doing this with strangles in this study, which I wish they would have defined the risk and gone $20, $30 out with an iron condor or synthetic strangle or anything like that, or even sell the front month and buy the back month at the expected move, something with defined risk, only because a strangle like this can use $100,000 in buying power. I mean, this is not a small amount of money to be used in this SPX product. I want to put that out there, that this is a very capital-intensive trade. For the ease of management, maybe we can extrapolate out that the iron condor would do, X amount of dollars as opposed to what the strangle will do. Again, this is a very capital-intensive trade, uses a lot of money.
Here's the thing. I will say that for the SPX and the 0 day, it is very easy to get it down to a reasonable level. You go out to like the 2 or 3 delta options on each side and just buy the wings. And they may take like a couple of percentage points or 5% off of your profits, but it'll be very similar to these results and will use a lot less capital. So if you want to kind of make it synthetic without changing the results that much, I would suggest doing that. It'll be very similar,
Yeah,
but you're right.
we were
Is
looking
talking
at
about
around $5.50 or so on that strangle that you were looking at. You can easily go out, 20, 30, $40 wide, pay $1.50 on each side. I'm just using a number so that you're getting $4.50 in credit, and take all these numbers that we're going to show you eventually, whatever they may be, reduce them by around $1, and then you could have a lot more, a trade that's more accessible to the masses as opposed to this trade that would use a lot of buying power.
It is, about 45 minutes after the open, but I'm looking at the same strangle that we would have done in this study, the 53.60 and 53.20 strangle in the SPX. And if you go out another $50 or even $40 on the call side, you're a 10 cents bid. I'm sorry, 5 cents bid, 10 cent offer, right? Compared to $2.20 call option, right? So that's essentially where you could define that. And then if you go to the put side, you're going to go a little further because there's put skew, but you go down to the 52.60 as an example. That's, another maybe, what is that, $60 wide. So again, you're not paying zero for them, but you're paying like $25. And then instead of a $100,000 capital requirement, it becomes $5,500, which that's a lot more reasonable, and you're not giving up all that much in premium. So again, correct. You can do it easily. And then here's the key. So a lot of people ask, if the profit targets at some point are not reached, the trade's held to expiration and just closed at mid price. So whatever the expiration price is, that's what happens if the profit target isn't reached. Okay. And let's take a look at the results. So this is just for closing. So we put it on. If it reaches profit target, we take it off, and that's it. That's the P&L for the day.
Got it.
What happens is if you don't manage it at all and you just put it on in the morning, hold it to expiration, your average P&L is actually negative, which surprised me a little bit. Your win rate 63%, your CVAR is 4,100. So that's basically your essentially, compared to the rest of this is your worst case scenario, right? You don't want to not manage this, especially if you're putting it on in the morning. If you do have a management target, either 50%, 35%, 25%, or 15%, you did get a positive P&L, relatively higher win rate, close to between 70 and over 90% if you're doing it aggressively. And your CVAR is lower, which means you're taking less risk. Again, if you close this at a profit target, you are managing early. It's kind of the same principle. You are getting the same effect.
You're right. I mean, I don't have anything to add. The numbers speak for themselves, and you did a good job of recapping it. So really, it really comes down to managing. Like we've always said, a lot of people look at trading and they want to set it and forget it like it's the easy way out. There is no easy way out on this. If you don't manage trades at some consistent interval, you won't have consistent results. I mean, that's just the way it is, because it's just human nature sometimes to, smoke a little bit too much hopium. Hope that a trade's going to come back, as opposed to, being mechanical with the trade, rolling the untested side, closing the trade for a winner, not being, piggish on a trade. It all comes down to mechanics. And I think at Tasty, what we've tried to harp on, but just being mechanical and putting yourself in a winning position, a higher probability of success from the opening of the trade.
Right. And I want to, and it's such a good way to put it. And I think what I want to point out here is, in this case, the 0DT case, it does pay to be more aggressive with your management. So in other words, look at the difference between managing at 50% and 15%. You manage at 50%, which theoretically you should say, well, I should make more money that way because I'm holding it longer. I'm holding it, instead of, if I sell it for $10, I'm trying to make $5 as opposed to $1.50. But what actually happens is, because of the volatility that you get more intraday, as you get closer to the close, it actually deteriorates from your average P&L. It goes to $37 and your win rate 69%. If you manage at 15% of max profit, which again, 15% of max profit, you can get that in the first half hour. First half hour, 45 minutes, that's reasonable. If the market doesn't move, you're going to get 15% probably around that time. I've seen it happen. win rate 94%, average P&L $61, and your risk is lower. Your C-VAR goes from almost 4,000 to almost 3,000. Your risk basically goes down by 25 percentage points, which is significant. And again, with these zero-day trades, you have to be aggressive in managing these if you want to stay consistent, because a lot of that premium comes out in the morning to the tune of around 15 to 20%. So if you can manage it right there, you don't have to worry about the rest of the day. There's no problem there. Okay, so this is rolling. Okay, so now this is saying, okay, we're not going to just close and get out of it. We're going to consistently roll to the next $20 out of the money strikes when we hit our profit target. Now, again, because the zero DT options don't move as much. I'm sorry, in the morning, the SPX may move a little bit, but if you reach your profit target, you may not have moved a lot in the S&P 500. You may be rolling these strikes maybe $5 or $10, so you're not moving them much, but you are getting actually a higher P&L across the board when you do roll. Win rates stay pretty much the same, and your risk stays pretty much the same, but you are getting that higher win rate. I'm sorry, you are getting that higher average P&L when you choose to roll it out and continue holding it. But again, this is not the same as just setting it and forgetting it, because you are taking those strikes and you're recentering them so that if you do have a big move, it still may not hit you because you've recentered your strikes. And therefore, you're essentially protecting yourself in that case. Over the past year, managing winners has been vital to success, and unmanaged strangles we're losing even before accounting for the need to buy long legs. I think this speaks for itself. A lot of the times we talk about not holding these past noon or to the close or whatever you want to do it. This just reinforces that concept. Traders who rolled positions saw more overall profits than those who closed them. But you did have more losing days. So in other words, that makes sense. In a sense, you can think about it. If you get out at 9:30 or 10 o'clock and you have a winner, if you do roll them overall, you can have more money at the end of the whole thing. But you will have some days where, you roll it once, it's now 11 o'clock, you're good. Now you roll it another time. Excuse me, it's noon, you're all good. Then you roll it again, and then you get whacked on one of the sides. It's a more consistent trade to just close it. If you roll it, you're going to have a little bit more risk, but over time you're going to make a little bit more money, which again comes back to the same concept: more risk, more return. It's just kind of playing out in a different way. When a zero DT trade is a winner, deciding whether to roll it or to take profits is a decision that you should make based on your own risk tolerance and profit goals. If you want to stay very simple, more of a set it and forget it, put it on once and take it off as soon as you get your profit target, and then wait for tomorrow. I think that, in my opinion, would be at least my takeaway and the easiest thing to do if you're doing these. But again, if you want to roll it, that's fine. Just mind the risk.
That's the way I do it too, Anton. I usually put it on, look for my profit target, and close it. Just going to that spread that you were showing just a moment ago at 550 is around 490. And if you bought the wings like I talked about to use a lot less buying power, which was taking up around $1 or so, I said you would sell it around 450. You're up the same 60, 70 cents. So the trade itself, whether it be the strangle that uses a significant amount of money, with a simulated strangle, and again, I just went $20 wide because a lot of our research shows that $20 wide gives you the best bang for your buck, risk versus reward. You can go much further out, like Anton was saying, $30, $40, $50 out, and you get down to 10-cent options, which would be a lot more like a strangle, but obviously using a lot more buying power. My example is $1,500 in buying power when we put the trade on, a little bit less because you sold it for $550. Now it's trading $380 just in the time of that little segment that we're putting on. So they move, and obviously they can move, in the opposite direction too. They can move, as equally as quick as they move for you, is maybe not quite as quick, but still quickly move against you too. So you got to be careful on both sides of the board. There will be many times when you're going to have, not a full loser because time value is there. We like to close these, before noon from a lot of our research that we've put on. So you're never really at a full loser, but you could be at a significant loser where it would take back, 2-3 days of your, maybe buck or two profit that you're looking to make on these trades pretty quickly on a bad trade. So again, managing this trades from the slides there, it looks like it's the best thing. Go ahead.
You have to be not only mechanical with these, but you have to set the risk such that you're comfortable with it. And I know that's an obvious thing to say, but with the zero DTs, it's even more, I think, important because when you have, let's say, a winning day, right, and then you have another winning day, the worst thing you can do is you set your risk up in that one day takes out like 2 weeks of. I'm sorry, one loser takes out 2 weeks of winners. That just sucks. Like,
Yeah.
forget about the P&L, right? But it just sucks, like
For your
psychologically,
yeah,
right?
for your, yeah,
So,
yeah, for
so,
your psyche.
so what I like, yeah. So what I do is, if you do want to do these, set your risk if you're doing Iron Condors that your max loss in an Iron Condor never exceeds 2 or 3 or 4 days of winners.
That's right.
Right. That's how I do it, because at least then I know that, okay, if the worst case is I wipe out the last 4 days. For me, psychologically, that's okay because, a week has 5 days and chances are anyway, whatever that number
It
is.
stinks, it hurts, but it's not a body blow. You know what I mean? It's not something
it's not a month.
Right.
Exactly. It's not like a month.
Yep.
So, but that number is determined up to you, whoever your personal risk tolerance is.